So now we are going to look at the different section of adjusting entries. Okay, so we're going to be looking at accruals, and we're going to be looking at revenues that we've earned or expenses that have incurred. So these are things that have happened in the current accounting period, but they haven't been recorded in the books yet. In the real world, these happen very infrequently. And the reason why is that, so, well, actually, I'll give you kind of examples as we go through. These are things that can happen and occasionally do happen, and you have to do adjusting entries for, but the majority of these kinds of things are picked up in the daily business, and you do them as part of your regular journal, okay? So, the first one here we're going to look at is accrued revenues. So these are revenues for services that we have performed, but we haven't received the cash yet. So in the real world, what happens is that we say we have, we provide a service to somebody, we give them some kind of a document to show that we've provided that service, and that document becomes your source document that you then create the entry to put in your computer. Or you actually do the source document in your computer, and as you make up the document in your accounting program, it automatically posts to the accounts. Occasionally, there's things that can happen where you provide a service, but you don't have it in your system yet, and that's where you would do an adjusting entry. And the kinds of things where that might work is, let's say that you went to a trade show. Say you have a company and you sell these pens, and you're going to a trade show with all kinds of people that sell office stuff. And when you're there at the trade show, you sell a bunch of pens. So now you come back and you've made all these sales, but none of it's in your computer system. So you would have to do an adjusting entry to recognize the revenue. Otherwise, if you're in your store and somebody comes in to buy a pen, you do the transaction right there, and then every day or every week you do your batches and you post it in your system, okay? So most of the time, the revenue is just through the regular transactions, but you do occasionally have things come up. So this is the revenue is recorded before you actually get the cash. So even if you were at a trade show, you might sell 100 pens to somebody and give them the 100 pens, but you open an account for them and they're going to pay you later. That would be the same kind of thing. These kinds of things that we're going to see in the Wiley book and in your homework are rent, interest, or services that we've performed, okay? So when we do these type of adjusting entries, and this is one that we've been doing kind of all along as a regular journal entry, but now it's going to be in the adjusting entries too, is to show the receivable exists. That means we're going to get the money later. So that's either going to be a notes receivable or an accounts receivable. I don't think we have interest receivable. I don't think we have interest receivable in our book. And it records the revenue that we've actually performed the service, so it records our actual revenue. So when we do these adjusting entries, we're going to debit an asset account. It's going to be like an accounts payable, a notes, not payable, an accounts receivable, a notes receivable, some kind of a receivable. And we're going to credit the revenue account. And at this point, everything should still be just service revenue. Yeah, so we debit an asset, we credit the revenue. Okay. All right, so here's an example. In October, Sierra Corporation performed guide services for $200 that were not billed to clients before October 31st. So what we would have to do is we'd have to debit accounts receivable, $200, and we'd have to credit service revenue, $200. You've already done that through like your regular transactions, so it's the same entry, but you're just doing it as an adjusting entry because it didn't get done during the month. Okay. Questions about that one? Any questions? All right, this slide right here is another one that just kind of shows what the possible ones are: interest, rent, services performed, but none of it's collected. And then the entry, the adjusted entry you do is to debit the asset, credit the asset. Okay, the next one is for accrued expenses. So these are expenses that you have to pay before you actually make the payment. So we have rent, taxes, interest, salaries. These are the kinds of things that occur all the time. And normally through daily interaction, you post them into your system and then you pay them later. So you get a bill in the mail for the electricity and you post it in your system and you debit utilities expense and you credit utilities payable or accounts payable on a regular day-to-day journal entry. But they're saying here that sometimes they don't get recorded, so at the end of the month you have to record it. And it does happen every once in a while. You know, you'll have finished all your entries for the month and it'll be like, say this is for the month of October 31st, you did all your entries for the month, and then remember it takes a couple of weeks to close your books. So it's the second week of November, it's November 8th, and all of a sudden you go, oh, I just got a bill in the mail for the telephone that I didn't post. So then you would have to do an adjusted entry to post that. That would be kind of something that would fall under there. And this is to show that we owe the money and to recognize the expense, because remember we want the expenses and the revenues to be linked together. So in order to do this adjusting entry, we're going to debit an expense account and we're going to credit a liability account. So it could be rent, could be, you know, the different things we looked at, utilities, could be interest, and we're going to look at a couple of different types of examples. So debit an expense, credit a liability. All right, so here's an example. So Sierra Corporation signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires Sierra to pay interest at an annual rate of 12%. Now, there's a formula here. You're going to see this formula more than one time in this class. It's not a really difficult formula, but you have to know what parts to put where. So the formula is face value of the note times the annual interest rate times the time. Or it's also referred to as principal times rate times time. P times R times T, okay? So the face value of the note is the amount of the note. In this case, it's $5,000. $5,000, $20,000, whatever it happens to be, all right? The second part is the annual interest rate. That's how much interest you would pay if you held the note for an entire year. So because that's for an entire year, we have to multiply that by a number in order to figure out how much interest we're doing for that one problem. So this is what has to happen. So in the denominator, the number on the bottom, the denominator, that represents the type of note it is. So there's two options. There's a month note or a day note. If they tell you it's a 3-year note, it's still going to be 12 on the bottom for 12 months, okay? So if it's a yearly note, like a 3-year note, 1-year note, 12-year note, it's going to be something over 12. If it's a monthly note, a 3-month note, a 10-month note, 120-day or 120-month note, it's going to be something over 12, all right? If it is a day note, a 90-day note, a 60-day note, a 340-day note, it's going to be something over 360. Now, on the bottom, that represents the number of months in the year, right? So then people say, well, why is the day note 360? Because there's 365 days in the year. So in the book, it describes why they do this in accounting. It's, you know, it has to do with shorter months and things like that. So it's, you just have to know that in accounting, the number that you use for the number of days is 360, not 365, okay? All right, so this one happens to be a monthly note, 3-month note, and you don't care about the duration of the note, really. You don't care if it's 3 months, 12 months, 6 months. You just need to know it's a monthly note at this point. Because the next thing you're going to do is you're going to work on the numerator, which is the number on the top. And the way you do that is you have to ask yourself some questions. The first question whenever you're dealing with interest is, has interest ever been charged? So you'll want to write this question down. Has interest ever been charged? Okay. Has interest ever been charged? If the answer is no, then you go from the date that the loan originated or the note originated to the date you're doing the interest. Okay. So if the answer is no, interest has never been done, you're going to figure out the interest from the date the loan originated to the date you're doing the interest entry. Okay. If interest has been done before, some of the problems will tell you interest is done monthly or something, then you do the entry for the last time interest was done until the date that you're doing the interest for. And this will make more sense as we look at these problems, but that's kind of the rule. You ask yourself, has interest ever been done? If it's no, then you're going to figure out the interest from the origination date to the date you're doing the interest. You ask yourself, has the interest been done? If the answer is yes, then you're going to figure out from the last time interest was done to the date you're doing the entry. And this is going to come back again when we get to the chapter on notes. Okay. So in this problem, the question is, has the interest ever been done? If they don't tell you the interest has been done, you assume that the interest has never been done. Okay. If they do not tell you the interest has ever been done, you assume the interest has never been done. So in this problem here, if the interest has never been done, what date are we starting from? The date the loan originated. And the date the loan originated was October 1. So we're trying to figure out the interest from October 1 to the date we're doing the interest. And when are we doing the interest? We're doing it at the end of the month because we do our adjusted entries at the end of the month. So this will be for 1 month, October 1 to October 31. So your fraction becomes 1/12.
Excuse me. If you say that they don't tell you that the interest has been done,
You assume it's never been done.
you assume it.
Yeah. If they don't tell you when the interest was last done, you assume it's never been done. Okay. So this becomes 1/12, and I don't know, what is 1/12 reduced to in a decimal? Does someone have a calculator? They can figure that out. Let me see what I have on here. I should know all these fractions by heart now, right?
0.083.
Okay, so this actually, 1/12 becomes 0.083333. So you would take 5,000 times 12% times 0.083333, and you would get $50, okay? Do not be inclined to take $5,000 times 12%, which would be for 1 year, and get that number and then divide it by 12. Because if you do not have a nice, neat, even number, you will not get the right answer. You have to do the formula 5,000 principal times rate, annual percentage rate 12%, times the time that you're trying to figure the interest out for. Okay? So does that make sense to everyone that we are figuring the interest for 1 month here from October 1 to October 31? Okay. Now, what if this problem said that we were figuring the interest for the quarter? How many months are in a quarter? 3. So then this would become 3/12. Okay. If they told you you're doing the interest for 6 months, it would become 6/12. If they told you, or if you counted it out and it was 6 months, it would be 6/12. Okay. All right. So the interest is $50. So what we do for this, hit the wrong button here, sorry. So what we do for this is we debit interest expense, $50, and we credit interest payable, $50. So we're going to have to pay that interest down the line. Any questions about that one? You will see that one again. Yes.
This is for one where you record the expense, but you don't pay.
You haven't paid it yet.
Okay.
Yeah. This is where the expense occurred that you haven't paid it yet. Okay, so let's go to the next one. So this is another type of accrued expense. So Sierra Corporation last paid salaries on October 26th. So if you look here on the calendar, October 26th is right here. That was the last time they paid salaries. The next payment of salaries will not occur until November 9th. So if you look at the calendar here for November, November 9th is the next payday. The employees receive total salaries of $2,000 for a 5-day work week or $400 a day. Thus, accrued salaries at October 31st are $1,200, 400 times 3 days. So what they're saying here is on October 31st, you have payroll due that you owe people for the 29th, the 30th, and the 31st. So that's 3 days times $400. So your employer does this all the time. Does everyone here get paid every day when they go to work? You get paid cash?
No.
Tips, yeah. But salary? If you're getting paid salary every day, it might be kind of shady, right? So when you leave, if you work 8 hours and you leave, your employer has a liability. They're liable to pay you. They have a wages payable. Now, they don't make an entry every single day, but if you work for a company that's really like up on technology and you are doing a time card by scanning the badge or something, it probably is going into their payables. Or at least it's going into like something to be approved for salaries and wages payable, and then when someone approves it, it goes right into the system. So you have to do an entry for this. You have to do an entry for the $1,200 on October 31st that you owe to your employees. And the reason why we're doing this is because of the expense recognition principle. These employees have worked the 29th and the 30th and the 31st of October, and that means they were working towards revenue generation. So the money you earned in October needs to be linked to the manpower that you had in that same month. So the entry is debit salaries and wage expense $1,200, and then credit salaries and wages payable $1,200. And then when you pay them on the 9th, this $1,200 will get paid, and the other portion of money on the previous slide, you don't need to know this, but just so you're aware, the other portion of money on the previous slide here for November 1, 2, and then 5, 6, 7, 8, 9, that amount of money, it's going to all be paid in November, right? That amount for November plus these 3 days for October. When they do that paycheck on the 9th, they will do the November dates will go directly into salaries and wage expense, and these 3 from October will come out of the payable because you've already put these into expense. So one's for October. Okay. Any questions on the salaries and wage one? Okay. Let's go to the next one. Oh, so this is the slide that just kind of shows that these could be for interest, rent, or salaries. And the adjustment entries were debited an expense and were credited in a liability. So that's the rule for this one. All right, so we are going to do these problems here. Stop